Hey everyone, welcome back. Today we're diving straight into a full, data-driven explainer on the fundamental stock due diligence for Thomson Reuters. We're going to strip away all the market noise and look strictly at their recent full-year 2025 and first quarter 2026 reporting to see exactly what's going on under the hood of this information giant. If you've been wondering how traditional data companies are actually pivoting in the age of AI, you are in the exact right place.
All right, here's our roadmap for today. We'll cover the engine, the segment breakdown, the financial dashboard, shareholder rewards, and finally, the 2026 horizon. Let's get right into it. Section 1. The engine. Let's start by looking at their business model and overview to see how they actually generate revenue.
You know, when most people hear Thomson Reuters, their mind instantly jumps to the news ticker, right? But check out this quote directly from their Q1 2026 executive summary. They aim to provide professionals with fiduciary-grade AI they can trust in the moments that matter. So they aren't just a news company. They're actually providing highly specialized software, proprietary content, and AI workflows. They're essentially empowering professionals across the legal, tax, compliance, and government sectors to make those massive, high-stakes decisions where, honestly, accuracy is literally everything.
Now, the actual breakdown of their revenue is fascinating because it completely flips the script on the standard perception of the company. Just look at where the money is actually coming from. Legal professionals make up a massive 36% of their revenue. Corporates are right behind them at 29%, and tax, audit, and accounting sits at 20%. And that famous Reuters news division everyone knows, it's only a surprisingly small 10% of the pie, with global print making up the last 5%. So at their absolute core, they are a professional software and data provider.
And that brings us to the predictability of their business model. As we evaluate their financial health, remember that revenue quality is just as critical as revenue growth. Consider this: a staggering 77% of their business comes from reliable, recurring revenue. Only 18% is transaction-based. Having that much recurring revenue creates a very defensive, highly predictable cash flow profile that can really weather economic cycles.
Moving on to Section 2, Segment Breakdown. Let's look closer at the core segments driving the growth engine, which management refers to as the Big Three.
First up, the legal professional segment. This is where they serve law firms and governments with AI-enabled research and workflow products. Right alongside that is the corporate segment, which handles complex compliance and workflow solutions for massive multinational organizations, literally including the 7 largest global accounting firms. These two segments right here are the absolute heavy lifters for the company's top line.
Next, we have the tax, audit, and accounting professional segment, which is a great contrast to the legacy Reuters media division. While Reuters is out there supplying vital global news to media outlets and financial firms, the tax and accounting side is busy delivering heavy-duty, AI-powered software tools directly to tax and audit firms all over the world.
So here is the crucial takeaway. 85% of their total revenue is driven by these Big Three professional software segments. That drastically overshadows the print and media arms, which sit at just 15% combined. If you're running valuation metrics on this stock, you really need to be comparing them against other high-margin software-as-a-service companies, not your traditional legacy publishers.
All right, Section 3, the dashboard. Let's dive into their FY 2025 financial performance to see how those segments translated into actual numbers.
Let's look under the hood. The fourth quarter data shows some really clear top-line momentum, and it's paired with expanding profit margins. Year over year, total revenues bumped up from $1.9 billion to right over $2 billion, which gives us a solid 7% organic revenue growth rate. But what's even better for us as investors is that their profitability is scaling faster than their costs. Their adjusted EBITDA margin actually expanded from 37.6% to 38.7%. Growth combined with margin expansion is exactly the formula you're looking for in a healthy business.
And beyond just the margins, their broader financial health is incredibly strong. Remember that Big Three segment we just talked about? It actually grew at an even faster organic rate of 9% for the full year 2025. Plus, they generated $581 million in free cash flow in the fourth quarter alone. As for risk factors and debt management, their leverage ratio of net debt to adjusted EBITDA ended the first quarter of 2026 well below their internal target of 2.5 to 1, so they have fantastic liquidity and very manageable debt.
Next up, Section 4, Shareholder Rewards. We're looking at dividends and capital returns.
When you're doing due diligence, capital allocation is everything. Generating cash is awesome, but how management treats shareholders with that cash is what really drives long-term returns. Consider this impressive number 33. That represents Thomson Reuters' 33rd consecutive annual dividend increase. They actually just bumped their annualized dividend by 10%, up to $2.62 per share. I mean, 3 decades of continuous dividend hikes, that's a massive testament to the defensive, cash-generative nature of their business model.
But they don't stop at dividends. They're also aggressively buying back their own stock. They completed a massive $1 billion share repurchase program in late October of 2025, pulling 6 million shares right off the market. And on top of that, they've already announced a brand new $600 million share repurchase program for 2026. This 1-2 punch of dividends and buybacks makes management's focus on returning capital to shareholders crystal clear.
Finally, Section 5, the horizon. Let's look at the 2026 financial outlook and management's targets.
Historical numbers are great, but investing is all about the horizon. Check out this quote from CEO Steve Hasker. He says they will continue to scale our agentic capabilities to deliver greater speed, clarity, and confidence. Basically, they aren't just slapping a basic chatbot on their platform. They are deeply integrating generative AI agents directly into their professional tools to handle complex workflows. It's all about widening that competitive moat and really leveraging their proprietary data to drive future value.
And management expects this AI integration and operational efficiency to yield some very specific results in 2026. They're targeting organic revenue growth between 7.5% and 8%. They also plan to push those adjusted EBITDA margins up another 100 basis points to a super healthy 39.2%. And perhaps most importantly, they're targeting roughly $2.1 billion in free cash flow for the year. The engine is literally tuned to throw off serious cash.
So, let's bring this all together. Take a second to consider these fundamentals. When you combine a nearly 40% targeted profit margin with a business where 77% of the revenue is practically locked in as recurring software subscriptions, all while they're integrating cutting-edge AI for the world's top professionals, ask yourself, does this mix of high margins and reliable revenue make Thomson Reuters the ultimate defensive play for your portfolio? It's definitely a fascinating case study in fundamental strength. Thanks for joining us for this explainer, and keep learning.